From October 19th through October 31st, U.S. 10-year Treasury yields traded in a tight range near 16-year highs between 4.85% on the downside and 5% on the upside. Now, the reason for the historically high yields appeared to be a combination of the higher for longer narrative, coupled with the concern that continued accelerating Treasury issuance could weigh on bond prices, pushing yields higher. Now, the latter concern was fueled by a poor 30-year auction on October 11th, when expectations were for 4.8%, but the glut of issuance traded at 4.85%. Now, although that seems like a small difference, it definitely seemed to affect the psychology of the Treasury, whose next refunding announcement was conspicuously light in long-end issuance. The announcement seemed to spark a move that drove 10-year yields down to 4.6% on November 2nd. That move was accelerated by weak economic data in the form of ISM and ADP employment report, and most importantly, non-farm payrolls. Altogether, the news events of the week of October 30th moved Fed expectations from a probability of 45 basis points of easing in 2024 to a current 100 basis points, according to the CME FedWatch tool. Now, if a trader believes that yields could head back up, they could express that by buying the November micro 10-year Treasury yield futures contract at 4.6 and targeting a move near recent highs of 4.95. Now, a stop for this trade could be placed below at 4.40. This trade can make $350 if the target is reached and risks $200 if you're stopped out of your level. If a trader believes that yields could continue lower from here, they could express that by selling the November micro 10-year Treasury yield futures contract at 4.60 and target a move to the September lows of 4.15. Now, a stop for this trade could be placed above at 4.85. This trade can make $450 if the target is reached and risks $250 if you're stopped out of your level.